Hey guys, welcome back to Diamond Nest Egg, where we talk about all the personal finance stuff you should have been taught about in school, but weren't. Many of us know that we can use our company 401k, 403b, or 457 plans to save for retirement. And some of us even have personal IRAs, individual retirement accounts, that we handle ourselves that have nothing to do with the companies we work for. Today, we're here to talk about a different retirement vehicle, the HSA, or Health Savings Account. HSAs were not created for retirement purposes, but they have grown in popularity in recent years as folks have realized, one, the tax advantages that HSAs offer, and two, how HSAs can be used in retirement to offset some healthcare costs that are rising at 2 to 3 times faster than inflation, according to insurance company TIAA. By the end of this video, you'll know how to determine if you qualify for an HSA and the 3 reasons why people that have an HSA refer to it as their secret retirement account. Do you have an HSA? Let us know in the comments below. For those of you new to Diamond Nest Egg, I'm Jennifer, money expert, personal finance guru, and student loan coach to Gen Zers and young millennials. And we're here every Sunday with a new video about your money, from saving and investing to insurance and retirement. So hit the subscribe button, turn on the bell, and jumpstart your debt-free, financially free journey with us today. So why is saving for retirement even important? Let's consider these sobering statistics. There are currently 10,000 baby boomers retiring every day. And according to the Stanford Center on Longevity, 1/3 of these baby boomers have zero in retirement savings. And to make matters worse, according to the American Association of Retired Persons, the current cost of retirement is between $1 and $1.5 million. Can you imagine? As I tell our clients in their 20s, it's never too early to start thinking about retirement, because the earlier you start, the more time your money has to grow. And as I tell my slightly older clients, it's never too late to start. Just know that you'll need to put more money each month towards retirement than someone in their 20s, assuming you both want to reach the same retirement goal. Let's take the example of Jess and Julie. Both have a retirement savings goal of $1 million and want to retire at age 65. Jess starts saving at age 25 and has 40 years for her money to grow at the average inflation-adjusted market rate of 7%. Julie starts saving 10 years later at the age of 35, so only has 30 years for her money to grow. Both can hit their $1 million retirement goal, but Jess only needs to save about $381 each month because she starts 10 years earlier at age 25. Julie, on the other hand, who starts at age 35, has to set aside approximately $820 each month. And finally, if you're Jane, who starts saving at age 45, but still wants to save $1 million for retirement by age 65, because her money only has 20 years to grow instead of 30 or 40 years, she would need to set aside a whopping $1,920 each month. I've included the link below this video to the savings goal calculator that we use to work out these numbers. If you want to see what your situation looks like, just plug in your savings goal here, your starting balance, the number of years your money has to grow, and the annual expected interest rate. We generally use the average annual inflation-adjusted market rate of 7%, but feel free to plug in another number here if your expectations are different. Then just click on Calculate, and voila! That's how much you have to save each month to reach your retirement savings goal. So wherever you are right now, if you're not saving for retirement, start saving today, right after you finish watching the video, of course. And if you're already saving for retirement through your company or personal retirement accounts, but have never given much thought to an HSA as a retirement savings tool, here are the 3 reasons that you should. And if you like this video, give us a thumbs up and smash that subscribe button. It really works wonders on YouTube and helps us spread our financial education efforts out to as many folks as possible in this community. So what is an HSA exactly anyway? An HSA is a health savings account with tax benefits designed for people with a high deductible health plan that can help them pay for medical expenses both now and in the future. If you're not sure if you have a high deductible health plan, the best way to figure this out is to ask your human resources department or your line manager or your health insurance company. I'll also walk through what a high deductible health plan is later in this video. Reason number one, we're HSA fans, is because of the HSA's triple tax advantage. Tax advantage number one, you're not taxed when you put your money into your HSA. Tax advantage number two, you're not taxed on the money that grows in your HSA. And tax advantage number three, you're not taxed when you take money out to pay for qualified medical expenses, both now and in the future. So basically, you don't pay any taxes at all on the money that you put in and take out of your HSA, so long as you use your withdrawal for qualified medical expenses. That's why using an HSA to pay for medical expenses in retirement is better than using your retirement accounts. Because with other retirement accounts, you either pay taxes when you put your money in, or you pay taxes when you take the money out. You got to pay them sometime, regardless of what you use that money for. What is considered a qualified medical expense is defined by the Internal Revenue Service, which is responsible for all things tax related. But in its latest guidance, it includes those expenses that are generally qualifiable for the medical and dental expenses deduction. Let's assume you start saving in an HSA in 2021 as a single person with the sole purpose of using it in retirement. So you don't withdraw any money until then. And let's say that you max out your contribution limit of $3,600. The HSA contribution limit increases every year to account for inflation. But for simplicity's sake, we're just going to assume that your contribution stays the same every year. And again, we assume the average inflation adjusted market return of 7%. If you save for 40 years, you'd have a nest egg of more than $787,000. And if you save for 30 years, you'd have a nest egg of about $366,000. And even if you save for just 20 years, you'd still have a nest egg of over $156,000 in your HSA. All this money is money you will never have to pay taxes on. How cool is that? So long as you use it to pay for qualified medical expenses. When you think of an HSA this way, you essentially treat it like an investment account that functions like your individual retirement account, but with even more tax benefits. Having said that, you will have to pay taxes if you use your HSA money to pay for anything other than non-qualified medical expenses after you turn 65. And if you do this before you turn 65, you'll not only have to pay taxes, you'll also have to pay a 20% withdrawal penalty. So do keep that in mind. Moving on to reason number two for why we're HSA fans, and that's because it's unlike any other account. With a company 401k or an individual retirement account, you need to start taking minimum withdrawals at a certain age, which is currently 72. With an HSA, though, your money can remain untouched for as long as you like. And also remember that you're not allowed to contribute any more money into your HSA once you're on Medicare, and you become eligible for Medicare at age 65. People also sometimes confuse HSAs with FSAs. FSAs are short for flexible spending accounts, which are for health purposes as well, but that's where the similarities end. With an HSA, the account is completely yours, and the balance is carried over every year. On the other hand, with a flexible spending account, you either use it or lose it. Whatever you contribute each year must be used up that year. I have friends who recently upgraded glasses for their entire family. No one needed new glasses. They just wanted to use up all the money in their flexible spending account because otherwise they'd lose everything anyway. With an HSA, this would not happen. Whatever you don't use just rolls over to the next year, year after year, earning interest or possibly even dividends if you've invested the funds wisely. And even if you get a new job or new health plan, you keep your HSA. It's yours. You can simply roll it into your new employer's plan or leave it alone. Either way, your HSA money is yours to use for qualified health expenses now or in the future. The third reason we like HSAs is because of this. You generally pay lower monthly premiums on your health insurance, which helps you save money every month. The reason the monthly premiums are lower is because, as we mentioned earlier, you must have an HSA qualified, high deductible health plan to be eligible for an HSA. A high deductible health plan is a health insurance plan with a high minimum deductible for medical expenses. The deductible is the portion of an insurance claim that you have to pay out of your own pocket. It's your share that you need to pay. So only after you've paid your deductible, your share, will your insurance company cover the rest, as per your health insurance contract. Because of this high upfront cost that you have to pay before the insurance company kicks in its share, because of this high deductible, the premiums you pay month to month are generally lower, which should help you save a bit more money every month, as long as you also keep your regular cash health expenses low. In 2021, the deductible for a high deductible health plan can range anywhere between $1,400 and $7,000 for self-coverage, meaning you only insure yourself. For family health coverage, the deductible can range anywhere between $2,800 and $14,000. Now that's a pretty hefty deductible, but it's also the reason why HSAs exist. The HSA was designed to help people who have high deductible health plans with paying for high out-of-pocket medical expenses. But listen, if you and your family are mostly healthy and rarely go to the doctor, a high deductible health plan plus an HSA is not a bad option, especially when you consider the tax and retirement benefits of an HSA that we've already talked about earlier in this video. Plus, regularly putting money into your HSA is like building a brand new emergency fund just for medical expenses, which tend to increase as we age. An HSA can help you cover your deductible and any other out-of-pocket medical costs that unexpectedly pop up now or in retirement. If you want to learn more about emergency funds and how to save smarter every month, check out our playlist here, where we walk you through how much you should have in your emergency fund, where to keep it, and other money-saving tips and strategies. And if you want to learn more about other ways to save for retirement, such as via your company 401k, a Roth IRA, or traditional IRA, then take a look at this video here. One more thing to remember about the HSA is that there are annual contribution limits, which we touched upon earlier. For 2021, the maximum amount that you can contribute to your HSA is $3,600 if you have self-only coverage under a high deductible health plan, and $7,200 if you have family coverage. We hope you enjoyed this educational lesson on HSAs. If you did, please give us a thumbs up, hit the subscribe button, and say hi on social or shoot us an email at hello@diamondnestegg.com. We'll be back next week with another money-saving, wealth-building video just for you. In the meantime, be sure to check out the other great stuff that's already on this channel.